Hi everyone, welcome to Financial 101 video series. My name is Victor, co-founder of The Fifth Person. So here at Fifth Person, we help retail investors to look for great businesses to invest in so that they can grow their wealth safely and consistently over time. So today I'm going to talk about returns on assets and how do you use it when it comes to analyzing a company. So by the end of this video, you should get a clear understanding of what return on asset is, how is it used, and how do you apply them. Okay, so if you're ready, let's go. Return on assets, in short, ROA, measures how efficient a company is at using its assets to generate profit. So the formula for ROA is the net income divided by the total assets multiplied by 100%. And the rule of thumb is we want to look for companies with ROA of above 5%. So if you are comparing two companies, company A and company B, right, and both these companies have the same amount of net profit at 10 million, by looking at the same profits, right, it does not tell you how efficient the management is at managing the assets. But if you were to include the assets into the formula, we are able to tell how efficient the company is at generating profits for every assets they have. So if you look in this case, company A have 300 million assets, while company B have 100 million assets. And if you calculate the ROA figure, right, you can see that company A have a ROA of 3.3% and company B have a ROA of 10%. So looking at these two companies, right, you can determine that actually company B is more efficient in generating profits using the assets as compared to company A. And in general, we want to look for companies with higher ROA because higher ROA is always better than lower ROA. So where can you find the figure to calculate return on assets? Okay, one of the most common place you can look for is the 10K or the annual report of the company. So right here I have the financial statement of Alphabet, and this is the income statement over here. The first thing is you want to get is the net income. So you can look at the 2019 at the bottom, that's the net income over here. So the net income for Alphabet in 2019 is 34,343 million. The next is you want to go into the balance sheet of the company. So when you go into the balance sheet of the company, you want to take the figure total asset. So for Alphabet, the total asset is 275,909 million. So that is the total asset. So to calculate the return on assets, you basically take the net income, which is 34,343 divided by 275,909 million multiplied by 100%. So the return on assets for Alphabet is basically 12%, which is above the benchmark that we are talking about at above 5%. So why is return on assets so important? Because when you look at return on assets, right, it gives you an indication, right, of how capital intensive the company is. Because companies that require large asset investment, right, or very capital intensive companies, right, they tend to have lower return on assets. Companies like your telecommunication, your railway, your heavy manufacturer. Whereas on other hands, we have companies like the software companies where they have very high return on assets because they require little capital or assets to grow their business. So in general, usually companies that have less capital intensive tends to outperform companies that are more capital intensive over a long period of time, because companies that are less capital intensive are able to generate more profits with minimum assets. Let us look at trends that we will look at when analyzing return on assets. So in general of time, we want to look for companies that have growing or rising return on assets. This means that the company is getting more efficient at using their assets to generate profits. Another good thing that we look at is companies that can maintain their return on equity. The ideal one is definitely the one that's growing. The second choice is the one that maintain. And the last one that we do not want is companies that have decreasing return on assets. Decreasing trend in return on assets means that the company's asset is growing much faster than their profit growth, which means that the company is investing more into assets that generate less return. Okay, so general rule of thumb again, we want to look for companies that is growing ROA or maintaining ROA, but must have a track record of at least 5 to 10 years. So let's look at this company called Visa Incorporation. So if you look at Visa, right, their return of assets for the past 10 years have been consistently above 5%. In fact, most of the years is above 10%, and their average return on assets is actually 12%. Next, we want to look at this company called AT&T Incorporation. So AT&T Incorporation is basically a very capital intensive business. They are one of the largest telecommunication company in the United States. Very highly capital intensive as compared to Visa, which is very asset light because they earn the fee through every transaction of the credit card. So if you look at AT&T, their return on assets most of the time below 5%. So if you look at their average return on assets, it's actually 4%. So if you compare Visa and AT&T, Visa is less capital intensive as compared to AT&T, which is more capital intensive. If you look at the share price over here, we can see that Visa outperformed AT&T over the past 10 years because Visa generates higher return on assets as compared to AT&T because Visa is much more less capital intensive. Like I mentioned earlier, companies that are less capital intensive tend to outperform companies that are more capital intensive over a long period of time because they can generate more profits with little assets. So next time, if you want to look for companies that generate good returns over a long run, remember to check out their return on assets. So by now, you should have a clear understanding of what return on asset is and how do you use it when it comes to analyzing a company. So key point to take note is that we want to look for companies with increasing return on assets or maintaining return on assets. And we want to avoid companies with decreasing return on assets. And we tend to look for companies with higher return on assets because they are usually less capital intensive as compared to companies with lower return on assets. So if you want to find out how you can find companies that can compound 10 to 20% a year for you, we have this free training video for you at The Quadrant Strategy. So you can find the training link in the description box below. It's a 60-minute videos that teaches you how to invest for profits. So go get yourself registered for the training link. And finally, if you like this video, do remember to hit the like button, share with your friends, and don't forget to subscribe to this channel for more videos and updates. Thank you for watching, and I'll see you in the next video.